Okay, let's talk to our guest about this, Matt, because we've got Michael Glennon on hand, the CEO at Glennon Capital, who's joining us on the desk here in Sydney. Michael, I know that this isn't something that you traditionally do in your business anyway, and that is invest in some of the bigger cap stocks out there. But last time we talked to you about this, last time you came on the program, and you said you wouldn't invest in Qantas. Does this change anything for you?
No, it doesn't change anything, but I think the deal's a good deal for Qantas. You know, there's losses in the international business, and it seems to address both the international side of the business and the Asian side of the business. More routes can go into Asia, and it is a better hub to fly to.
What do you think it means for some of the other airlines that operate around the region and in Australia in particular? We know that Virgin's been trying to snare some of that higher end of the market, and it's been successful in doing that. But now having this big Middle Eastern carrier associated with Qantas, we know that Virgin has this Etihad partnership, but I guess Emirates really dwarfs Etihad when you look at its fleet and its range of destinations and whatnot.
Well, on that upper end of business travel where Virgin's targeting to take share off Qantas, it'll mean that people flying internationally to other destinations can come straight through and stay on the same carrier. So their bags, they don't have to change flights, so that'll make it a little bit harder for Virgin to take some of that business. In the Asian market, it'll make it mean it's a little bit more, Qantas can be a little bit stronger competitor to Cathay Pacific and Singapore Airlines, so that's quite good, and that gives them an opportunity to stem those losses that are coming on that international side, so they can divert planes into that market, which they've already announced they'll do. So I think it's a really good deal for the business.
Okay, all right, good stuff. Well, and you know, the share market obviously likes the deal, as we've...
Yeah, it's reacting very well to it.
Yeah, Matt already showed us. Let's talk about what you do like in the market out there, Michael. I know Domino's is one of the companies that you're currently invested in.
Yeah.
Can I just point out the PE here? The forward PE is almost 20. I mean,
yeah, it's 20. It's 21 times. Look, we don't look at the PE though of the business. It depends on the capital structure, the debt, the equity that's in the business. But the business has done very well. I think it's up about 60% over the last year. So it's been a fantastic performer for the portfolio. And you've really got to look at, in this type of market, it is a little bit expensive. It's getting close to our valuation. But it's always been an expensive stock. The management's always delivered. I think they've had something like 17 halves of consecutive growth now. There's a lot of room for expansion internationally in the Netherlands. They rolled out, I think it was 53 stores over the past 12 months, so still a lot of growth in the business, and you pay for that type of growth in this type of market where you have got a flat economy.
Webjet's another one of your favourite picks. We were just talking about this yesterday.
Yeah,
it's been almost every other day we have someone that comes on that likes a number of the internet plays, and Webjet's one of them that comes up constantly. Considering that, maybe people might have missed the boat on this one, would you think?
Look, I think they have. It's also getting very close to our valuation. I think I was on here in December last year and the stock's up nearly 50% as well. So it's been a really good performer. It's a great business and it's a very scalable business model. You compare it to a flight centre type business that's got all those bricks and mortar stores to deliver a service. You know, Webjet's got a very good business model. Huge amounts of upside for them delivering travel. They're expanding internationally, so it's a really good business, and that web portal provides a huge amount of growth for the business.
Is Flight Centre too big for you?
No, Flight Centre, we can still invest in Flight Centre, but we prefer Webjet. We think it's a better business model. You know, the numbers are starting to look good on Flight Centre. We've been in and out of Flight Centre at various different times, but our preferred play is Webjet at the moment.
And Macmillan Shakespeare, haven't heard of that one for a while.
No, we talk about that very rarely, but it's you know, it does.
Yeah, it's a great little business that's doing well. It's nearly $1 billion in market cap now, so it's a remuneration business. It's been a really good performer as well. So if you put that in the contrast of what the small caps have done and the market, it's a fantastic business. It's just done a deal with the South Australian government. Revenue's growing strongly, profits growing strongly. It doesn't use a lot of cash, so we really like the business.
Michael, are you invested in anything right now ahead of possible QE, both in the US and Europe?
No, look, we don't really focus on that. We look at the individual businesses and how they're performing and where we think we can get growth out of those businesses. And we are cautious of some of the macro factors. We're out of resources. We've got a lot of cash. We're concerned about the Australian economy, the high dollar and interest rates, which we think are a little bit high at the moment.
Out of resources, that's interesting, given what we've seen in commodity prices, right?
Exactly, yeah.
Okay. All right, Michael, good to have you with us.
Thank you.